Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Mitri Pragmatic. How you doing, D?
Good morning, Will. How are you?
Great.
I'm
going to start with the disclaimer.
Before we get started, everyone, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need to speak to a registered advisor, call your registered investment advisor or broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent. So what are we seeing this morning?
Let me share my screen. And anyone joining us for the first time, just a reminder, what we do the show for is to answer any questions you may have about Market Chameleon tools, the data analytics. If you want to talk about strategies or something unusual you've seen, you're welcome to either put that question on the live chat on YouTube. Will's watching it. He'll read them back to me. If you want to come on a show and ask your question live, we also have a link there to Zoom. If you click on that link, it takes you over to Zoom. Once you're in Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera. It'll prompt you to do that. You can decline that, but once we let you in, everybody could hear you and you could ask your question live and direct. While we're waiting for questions to come in, we'll go over the pre-market report quickly, see what's trading in the pre-market hours. I could also continue on Microsoft. Yesterday, we started out looking at its earnings, getting some insights. I could continue on that until we get any questions. Then I'll take those questions first. Okay. Perfect. So the pre-market report, these are stocks trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Down here, I see 141 stocks made our percentage gainers list, 49 on the decliners. And from that perspective, we are looking like we're setting up for a more bullish bias at the open. And so far, I think earnings have been coming in. They've been looking pretty decent. I think the GDP number came in today, I believe at 8:30. Looked like that was pretty decent. So a little bit of bullishness right now in the market. While we're looking at this report, if you guys notice that a lot of these symbols here that are making the pre-market report are either small cap stocks, they could be ETFs, preferred stocks, closed-end funds, anything that's really listed on the major U.S. exchanges and it's trading pre-market can make this list, meets our thresholds. And to get more insights, we want to narrow down this list to a certain group of stocks. And what we'll do is narrow down to S&P 500 companies to get insights what's going on there. And to do that, I'm going to use this filter here in ETF. We're going to drop it down. We get a list of ETFs to choose from. So you see the first one up top, SPY. That's the S&P 500 ETF. When you select it, the list below will get filtered by stocks that are holdings in that ETF, right? So let's do that. And now we filtered out SPY holdings, which are the S&P 500 constituents. And we see here that 28 stocks made our percentage gainers list, 9 on the decliners. And what we see here is near the list of stocks, if we go to the alerts, if you see that little E, that's alerting that earnings was just released either this morning or yesterday after the market closed, and the stock could be reacting to that earnings news, earnings event. And we've got a lot of E's today, as you could see on the gainer side and on the decliner side. But here we're seeing that 28 stocks still, 28 stocks made our percentage gainers list versus 9 on decliners. And from that perspective, again, looks more bullish bias at the open so far. If there are no questions yet, we'll what I'll do is maybe navigate to Microsoft, kind of continue on the earnings insights.
Yeah, that's fine.
Okay. Let's go up here, take a look at Microsoft. And yesterday, what we did was look at Microsoft from the perspective of historical earnings moves. We looked at the magnitude of the moves, how the stock reacted the day after, including, the opening gap. How did the stock traded from the open to the high, to the low, to the close of the day. We looked at, not only the magnitude, if it had tendencies to move in one direction versus another, and then we compared that to how the options predicted the move the previous day. So we did look at all this yesterday. And now let's take a look at how Microsoft tended to move post earnings. So we're going to get some insights from here. And then, maybe I'll take a look at how the options tended to behave. And what we could do is go to the option strategy. Let's try to create an outlook based on this data. And when we create an outlook, let's see if we could then go to the options chain and create a strategy that would be in line with our outlook. All right. And we'll try to see how we could create a strategy with, limited risk, good risk reward potential. So we'll see if we could do that. Okay. So I didn't prepare it ahead of time. I'm doing this on the fly. Okay. So here we see from a directional standpoint, usually we look at options from volatility and movement. But if you're looking at Microsoft from a directional standpoint, and if we're comparing how the stock moved before earnings, day of, after, here we look at certain periods. These are periods before heading into earnings. This is just the day of earnings, and these are periods after earnings. So not including the earnings, just afterwards. And if we come down here and look at the percentage moves and the percentage of up moves versus down moves, right, over a 2-week period, 1 week period, 3 days, using the last 12 quarters, we see that, tended to move higher heading into earnings. The best one, maybe like starting 2 weeks into it. On earnings, wasn't really, if you're just playing a movement, it wasn't very good. If you're playing a directional movement, it wasn't a very good time to do it, because you could see here, nobody knows what the stock will do if it has bad earnings or good earnings. So as directional, here you have on average was break even, 50% up, 50% down, break even. So it wasn't a good time, to play a directional move really historically. Moved up, moved down, break even. You can see the gap moves, and so forth. So what about heading out of earnings? So people get to digest the news. They get to see what Microsoft says. You get to read the news. You get to see, what kind of forecast they give, forward-looking statements, the state of their business, how they did in earnings. So all of a sudden there's more certainty, right? So the uncertainty of that earnings is gone. There's more certainty. What do people tend to do? Obviously, that first day there's a big repricing, and then heading out of earnings, you could see that it tended to start to rally. And here maybe on a 1-week basis, historically, it tended to rally. So once people had that certainty in place, got to read the news, that's what it tended to do, right? So we'll keep that in mind right now, that tended to be strong post earnings. All right. And let's leave it at that for now. Okay. Maybe we give it a little bit of a bullish bias. I'm going to come over here. I just want to see how, using the trading stats, how Microsoft did relative to the rest of the market. So this is Microsoft's returns. We see them here on different periods: 1 year, 6 months, 3 months, 1 month, 2 weeks. This was yesterday. We could compare it to SPY, and just looking at it, it has been underperforming, right? We could just see period to period. It's been underperforming. Maybe the last 2 weeks did a little bit better. And we could kind of look at this table here. This table compares Microsoft versus SPY, and then compares it as a pair. And on a 90-day basis, this is highlighting that SPY was a better risk reward. 30 days, it's highlighting better risk reward, even on a 15-day period, 2 weeks. And this is looking at it from a perspective of not over a 2 week period, 3 months, but daily performance. So it's looking at every day SPY versus Microsoft, right? So we can see here, out of the last 15 days, Microsoft was up 60% of the days, SPY was up 60% of the days. So that's good, right? That's pretty even. But on average, Microsoft moved up 0.5% versus an average of 0.75% in SPY. So obviously SPY was a better performer. And if we look at the standard deviation, Microsoft standard deviation is higher than SPY. So you got more return in SPY versus and less volatility versus Microsoft. So we can see here, that's been kind of consistent. So on a relative basis, Microsoft has been weak. And if that continues, obviously, you're better off in SPY than in Microsoft. So keep that in mind as well. We've got to be that the market can be signaling caution there. Let's go take another analysis. We'll take a look at the implied volatilities. And we know already the earnings has come out. We've seen how the stock tends to do after earnings. And implied volatility tends to decline 14% the next day after earnings. But what about 5 days later? So if the day after earnings, the average implied volatility is 28, we could see here 5 days later it's 25. So the implied volatility over the next 5 days tends to decline. All right. So what do we have so far? As I'm trying to create a potential outlook, and around that outlook, I'm going to try to create a strategy. So far, what do we go over? Microsoft tends to go up post earnings. However, so far we've seen that it's been underperforming the rest of the market, the S&P 500, on a short-term and intermediate basis. And also, post earnings, Microsoft implied volatility comes in, but it's not fully in yet. It tends to continue, implied volatility continues to go down over the next 5 days, 5 trading days. All right, so let's keep all those in mind, and then we're going to go to the options chain and try to create a option strategy with those types of parameters. Okay, so let's go options chain. And stop me, Will, if you have questions or people want to.
Well, we did have one comment from 4D was asking. He wanted to confirm yesterday. So to my question yesterday, the stocks that release earnings after the market, the move doesn't get recorded on MC for that day since the move happened AMC after the market closed. So it is recorded. So it is recorded basically just all from the data for trading hours the next day, the move.
Yeah, exactly.
All right.
There'll be two moves. Yeah, we record the opening gap, so the move from the previous day's close to the open, and then to the close. So for the whole day. Yeah, exactly.
Yeah. And
Um,
Laurent popped in, and I guess Tesla's earnings was just the other day, and he wonders fundamentally if those on the fundamentals, does that flow through, I guess, update with the new information? And he wants to see how it's showing for fair value now for Tesla.
so don't think it's going to flow right away because so the fundamental data, we have vendors that we purchase the data from, and it depends when they enter in all the new information and we get it. So it's not like real, it doesn't go into the database real time because the fundamental information is not like it's not like a feed coming from the stock exchange with earnings and guidance and all this. It's actually people have to manually look at the data, put it put it into the right place. We get it from Morningstar, right? So they have to put it in the right place, and then our systems are automatically just picking up updates coming from the vendor, right? So earnings are reported, but it's not like a stock price. There's somebody there going to the SEC filings and putting each or reading the press release. So sometimes the press release and the filing happen on different days. So the SEC filing doesn't have to happen exactly at the same time as the press release. I don't know exactly their delaying process. It's different for different stocks, and it's manual. But as far as fundamental data, we purchase that data. It's from a vendor, but it's a manual process. And until they put it into their database, put it into the feed, then we pick it up, and then our systems start updating. So I guess the answer is no, it's not immediate like that.
I mean, the Tesla's up $13 in the pre-market. Big move.
Yeah. Well, but we're talking, Will, about their fundamental. I think the question was.
Yeah, it was. No, I'm
just
looking at the Tesla. I realized why we're talking about it this morning.
Yeah, not the stock price. We're talking about the their revenues, their earnings per share,
where we calculate the implied fair value and the fundamentals.
Yeah, that's what we're talking. Yeah. So no, it doesn't it's not immediate like that.
Perfect.
Yeah. And we don't have a feed that's immediate like that. Not that I know, and we've searched. So everybody does it. It's a manual process. All right, Microsoft. So let's start out, with Microsoft. I'm going to go out a week. Okay, let's just say we go out a week. I don't have 5 days, let's say 7 business days. And let's start out with a bullish call spread, right? Microsoft tends to go up. So let's say we want to do a bullish call spread, but we don't want to be too bullish, or in the sense that it's not going to go too far, because we've seen that Microsoft also is a little bit weak relative to the market. So let's just do maybe a call spread. We'll start out. Where's the stock right now? Here. Start out with a call spread. I'm going to sell the 240. Maybe buy the 237 call. Let's start out that way. Right. So this here is a call spread. This is the market, $1.35, $1.60, midpoint 150. Let's keep it at 165. And you could see here that if the stock in the next 7 days kind of just sits here at 240, then this spread will be profitable, right? Because then not very profitable, but like depending if you buy it for $1.65 or $1.50, but it is a with a $2.50 call spread. If you buy it for $1.50, it's 50 cents. So we'll profit. Let's say we bought it for $1.50. It'll be 50 cents profit. But if you're risking $1.50, a 50-cent profit on $1.50 is a pretty decent percentage return in 7 days, right? If we think that there's a better chance that Microsoft is going to go higher from here or just stay here, and it did tend to move higher. But maybe what we could do is turn it into and say, but we think that the upside would be limited. And if the upside is limited, maybe what we could do is also reduce that cost of that spread if we limit, if we choose a limited upside. So let's take a look at something like, what did I say, like maybe like, let's go up 3% from here, 247. So it tended to move up, what, 2.5%, well, something like that.
Yeah.
Let's say we limit it to here. If we sell that call, right? We sell that call right now, and we stop ourselves out at 250, just in case something happens and the market really rips. Right? So I'm going to buy this call. So what I did was I bought a call spread, and then I sold a call spread in the same expiration with the outlook that I think it's more likely to go up than down. I think that the upside will be limited based on Microsoft has been underperforming the market, and that tended to go up, but I picked a target where like where on average that was its return for a week. So let's see how that looks, that strategy. This here looks like a condo, basically. So here, if we could get it at midpoint, 89 cents, it's $1.09. If we're right, and you can see here we have a little bit of a bullish bias because the stock is right here. So this is where the stock is. So it can go up, right? And we're still profiting up to here. And if it goes down, we do lose 109. So what we did was we created a strategy where we're risking, let's say $1.09. Really, you want to get it over here, 89 cents, right? But $1.09 to make $141, so more than double. So if this outlook, if we're right on this outlook and the stock is going to stay here or move higher, trend higher, and stay within this range, not go higher than that 2.9% at expiration, that's more than double the return on the money amount at risk. All right. So of course, if you buy it at 89 cents, that's even a better return, right? Because then your risk goes down and your return on the investor risk goes up. What else we see is we are short a little bit of Vega. So what will happen is that if the stock is kind of doing what we're thinking it's doing and implied volatility start to come in, then we will benefit from that, where the profit, will start moving up higher as we get closer to expiration, right? So this is our max profit, but 1 day, 2 days, we should, if it's behaving the way it did in the past, we should start seeing that profit coming in, okay? And you could see here, this is your gamma, short gamma, and long theta. So if the stock does nothing every day, everything else the same, you should start getting positive theta, all right? So that's a really quick kind of trying to take a viewpoint. Now, I didn't read Microsoft's fundamentals. I didn't do that. I'm looking at kind of quick evaluation, saying, okay, news is out. it looks like it's, it went down, then back up, kind of unchanged here. So if everything else looks like, it normal, and if it does continue and what it usually does, this strategy here, stands to make over 100% return in the next 7 trading days. All right, I'm not telling you to go do it. Remember, guys, I'm not telling you to go do it. Just demonstrating, creating an outlook, and then using options as a strategy to create a good risk reward setup, using the options around that outlook, capping and limiting your risk. Okay. Any questions there? Anybody?
Well, Rob asked, is this a credit spread? Does Dimitri mean selling the spread as a credit spread or buying a debit spread?
So this one, actually, the way I set it up is a debit spread, because I used 2 call spreads in the same expiration. But the same strategy can be done with an iron condor, selling in out of the money put spread, selling in out of the money call spread, receiving a credit, but the payout diagram would look the same, right? So it wouldn't change the risk and the payoff. It shouldn't, otherwise you have an arbitrage opportunity. But you can do this with a credit. Maybe I'll show you really quickly. Let's leave these calls, the call spread here, and what it will do is change, instead of buying this call spread. Watch, I'm going to do the same thing on a put, sell the put spread, selling it at 240 put, and I'm going to buy back the 340 put, right? And I'm going to get rid of this call spread here. So I'm going to remove hold on. Where are those calls? Are these the calls? 240, 230. So I got to remove these, this one and this one. Okay. So now we turn it into a credit, $1.46. Of course, you want to get a $1.64. So you could see here, whatever you sold it for, that would be your max profit over here. Same payout diagram. You lose 104 on this side to make a 146. And of course, you do want to get a better price, because you can see this is why. This is if you go out there and just hit the markets. But the idea behind it is that, well, if you think that this is more likely scenario, right, and you got a chance to more than double your amount at risk, then it offers a good setup, right? Potential risk reward setup. So you can convert it into, again, it's really, you could do it 2 ways, right? You can do it as an iron condor, selling the put spread, selling the call spread, or you could do it like a double call spread, where you're buying the call spread, selling the call spread up top. But the profile, the risk profile, the payoff profile will look the same.
Awesome job, D. The bell just went off.
Okay.
Chameleons are very thankful for everything you do for us. Awesome job, my friend.
All right, great. Well, thanks everyone for joining. Stay safe out there. Have a great trading day, and